Good afternoon and welcome to the New Capital webinar, looking back at 2019 and ahead to 2020. This is Catherine Barr, Director of Communications at New Capital, and I will be the host of today's webinar. If you have any questions, you can click the chat option at the bottom of your screen and then type them in. Leonard will answer any questions about the content of the webinar in a Q&A session at the end of the presentation. So welcome to the webinar. We're glad you're able to join us. Before we get started, I'm going to make the following regulatory disclosures. This New Capital presentation is being made available for educational purposes only and should not be used for any other purpose. The information presented does not constitute and should not be construed as an offering of advisory services or an offer to sell or solicitation to buy any securities, related financial instruments, financial services, or other services in any jurisdiction. Past investment performance is not an indication of future results. Wherever there is the potential for profit, there is also the possibility of loss. Certain information contained herein concerning economic trends and performance is based on or derived from information provided by independent third-party sources. New Capital believes that the sources from which such information have been obtained are reliable. However, we cannot guarantee the accuracy of such information and have not independently audited these sources. Okay, thank you. And now I am going to turn it over to Leonard.
Thanks, Catherine. Good afternoon, everybody. I hope you're doing well. And as you can see, I still have my winter beard with me for, I don't know, a few more weeks of winter that we're going to have. So let's start with this. Imagine it is early January of 2010, and you are reading a review of the financial markets. Again, January of 2010, a decade ago. Investors have been on a roller coaster over the past 3 years, 2007, 2008, 2009. Living through the stress of the global financial crisis and market downturn of 2008 to 2009, and then experiencing the recovery that began in March of 2009 and is still going strong in January of 2010, several months later. Investors who rode out the market slide are beginning to be rewarded, but the rebound is 10 months old, and markets have a long way to go to reach their previous highs. Opinions are mixed about what might unfold in the coming year. A December 2009 headline in the Wall Street Journal underscored the uncertainty with the headline, "Bull Market Shows Signs of Aging." The publication pointed out that although stocks have rallied and indices are on the rise, worries are mounting in some quarters that the market is running out of steam. That would have been right here. And had you heeded the Wall Street Journal at the time, had you said, all right, the bull market is now aged and has run out of steam or is running out of steam, this is what you might have missed. $10,000 grew to $23,473, and that is for the MSCI All Country World Index. January of 2010 to December of 2019, the month just ended. Over the past 2 decades, and on this chart, anything in this darker blue, teal, I guess, is the 2000s. The 2010s are in gray. This is what stocks have done across various geographies, U.S., developed international markets, and emerging markets. U.S. has had a very strong period in the 2010s. Look at this. Large companies, small companies, growth companies, value companies. As many of you know, growth companies and large companies have outperformed small companies and value companies. But all those have done well, in excess of 10% annualized. The previous decade, the 2000s, however, look at this. Large companies were negative. Growth companies were negative during the 2000s. Small companies were up around 4%, value companies up around 3%. And look at emerging market stocks during the 2000s, at a time when U.S. stocks were all down, emerging market stocks all strongly positive, but less so during the 2000s. International stocks, kind of a mixed bag, mildly positive in the 2000s, negative in growth stocks, and positive, but not nearly as positive as U.S. stocks. So that's what the picture looks like over the last 20 years. Here's the longer view. Sorry, it takes me a little bit to get to the drawing tool. Here's the longer view, 2000 to 2019. So if you put the 2 decades together into a 20-year look back, we can see that actually small and value did outperform large and growth over the 20-year period. And it did so as well in international stocks, and it did so as well in emerging market stocks. So the lesson is that when we look back, we really have to look back if we're going to be able to glean any learnings about the markets. And we're in one of those times right now when growth stocks and large stocks have done very well, better than small stocks and value stocks. But that doesn't mean that that's what's going to happen in the 2020s. We don't know what's going to happen in the 2020s. But this is what's happened over the last 20 years. Let's look at 2019 now in specific. It was a way up year. Way up year. Stocks, 31.5%. That's U.S. stocks. It was the 18th best year for stocks since 1926. 18th best. So just in case you're thinking, oh, that was the best year ever for the U.S. stock market, not quite. It was the 18th best year for stocks since the 1920s. Bonds also had a very strong year. It's the 19th best year for bonds since 1926. Bonds were up 8.7%. Usually we would say that's a stock-like return, isn't it? I'll take that in a stock return. Bonds delivered that, and that happened in a year when interest rates, to the surprise of most people, fell. So, only 4 years have been better than 2019 for both stocks and bonds. That's the key. So if you take stocks and bonds, only 4 years have been better than 2019 was. Out of 94 years, 1 year was 1985. Stocks did 31.7 and bonds did 22.1 in 85 and 89, 31.7 and 14.5. 1995, 37.6 and 18.5. 97, 33.4 and 9.7, which looks a lot like 2019, 31 and 8.7. And going back to the survey question, what happened the following year? In 1985, the following year, stocks were up 18% and bonds were up 15%. In 1989, stocks were down 3%, bonds were up 9%. In 1995, stocks were up 22% and bonds up 3%. In 97, stocks were up 28% and bonds up 8.7%. So for those of you who automatically assume that 2019 was a way up year and stocks have got to fall, they must fall, got to go down, they might. But there's nothing in this chart that indicates that they must. We don't know what's going to happen this year. And it's already been a mixed bag. Stocks started out strong here in January, but are not finishing strong. They've fallen off the pace. And I think last time I looked, we're about even for the year in stocks. All right, moving on here. As always, I like to show this chart to remind everybody that in any given year, there is going to be a period when the market is down. This dates back to 1980. And just to remind you what this chart is showing, the performance of the market each year is here in gray, right? This is the drops off here. This is what the market did for the year. This, of course, is the financial crisis, 2008. The red numbers show you what was the maximum point, what was the maximum low point in the market for the year on a percentage basis. And you can see that every single year that the market had a period when it was down. The closest ones to not having any period when they were down was a zero right here. That was 2011. In 2011, the market was down at its most nothing. It was even. But every single other year, the market was down. So you have to prepare yourself for that. So if we get a down point here in 2020, there are going to be a lot of people who say, this is it. This is the bear market's here, and here it is. The problem is we're not going to know. We're not going to know if that's the case. It might be the case, but it's not necessarily the case, as you can see from this chart. All right, let's take a look some more at the stocks in detail here. Here's the S&P 500, and you can see this has been a very, very long bull market. It is now the longest bull market since the 1920s. A 378% gain in the S&P 500 from the market low that was hit on March 9th of 2009. The price to earning ratio at that time, I don't know if you can see it, 10.3. 10.3. That's the valuation that the stocks were trading at. And here we are in the end of 2019, and we are now at 18.2. So the expensiveness of stocks has gone up substantially from that low point. And of course, the value that stocks were trading at back in 2008, March 9th of 2009, has, of course, contributed mightily to the long rise in stock values because stocks were relatively inexpensive at that time. And we can see right here in this table the change in very important key metrics. S&P index in 2000 was at 1527. In 2007, October the 9th, it hit a market high of 1565 right here before crashing down. And look where we are now, 3,231, doubled from those, more than doubled from those. In 2000, look at the price to earnings ratio, 27.2. That was the tech bubble. That's when everybody couldn't get enough of Cisco and WorldCom and Dell Computer. 27.2 was the price to earnings ratio, the forward price to earnings ratio. Not even the trailing, the forward ratio. 15.7 in 2007 at the market peak before the financial crisis. Where are we now? 18.2, as I said before. Dividend yield, 1.4, 1.9, 1.9. Look at the difference in the 10-year Treasury bond. Back in 2000, if you did not want to own any of those tech stocks, if you said, I know everybody wants to own Dell and WorldCom and Enron, but it feels expensive to me and it feels really risky and I don't want to do that, you had a place to go. The 10-year Treasury bond, what is considered to be the risk-free asset, you could buy with a 6.2% yield. Pretty good, isn't it? So you had a place to go. In 2000, if you didn't like valuations in the stock market, you could have gone to not just the bond market, but to what is regarded as the safest bond that you can own. I understand now we could get a lot of differing opinions about the United States Treasury bond for all sorts of reasons, but it is still considered to be the risk-free asset. And look, you could own it. Even in 2007, you could own the 10-year Treasury bond and get a 4.7% yield if you did not like what the stock market was offering in terms of valuation back then. And as it turned out, of course, the market fell. But look at us now. If you don't like the stock market at 18.2 times earnings, that's U.S. stock market. We're going to talk about it international in a little bit. But if you don't like the U.S. stock market at 18.2 times earnings, and that's the market as a whole, doesn't even take a look at growth stocks, which are trading at a much more expensive valuation. We'll look at that in a second. Your choice is to own bonds with a 1.9% yield. Now, how appetizing is that to all of you out there on the call today? 1.9%. Locked in for 10 years. So this is the conundrum that we face right now in the investment world. So let's talk about, what do we do? Well, this is an interesting slide. This comes to us from Capital Group. You may know Capital Group because they are the company that sponsors the American funds, which I have been looking recently at doing more with that group for various reasons. Look at this, a very, very interesting chart. Since 2010, 74% of the top stocks, the top performing stocks, 3/4 of them have been based outside the U.S. Now, that doesn't mean that that a particular international index has outperformed the U.S. index. Again, what this says is that 3/4 of the top performing stocks in the world, 3 out of 4 have been based outside of the United States since 2010. And you can see this in this chart. In 2010, emerging markets accounted for more than half of the top performing stocks. Developed international in 2010 accounted for more top stocks than the U.S. Here's the U.S. in blue. Next year, it was a different story. The U.S. had more than 50% of the top performing stocks in 2011. But look, it reverses again in 2012. U.S. accounts for a small fraction of the top performing stocks, 50% here for the U.S. Maybe a third or less here. Really small portion in 2015. Most of the top performing stocks in 2015 took place outside the United States. Same thing in 2016. Same thing in 2017. Look at this. 3 years in a row where the U.S. barely shows up with the top performing stocks in the world. U.S. back in 2018, about 50% or so. And in the last year, when the U.S. stock market outperformed outside the United States, still The majority of top stocks were outside the United States. So this chart is a very good reason why I emphasize that during a time of uncertainty and higher valuations right now, I invest your portfolios not just in the United States, but outside the United States as well. And I want you to be comfortable with that, and I want you to understand why that is. And this chart should really bring that home to you. Let's take a look now at valuations in different sectors in the U.S. market. We know that since the market peak in October of 2007, right before the financial crisis, that growth has outperformed value. Large growth has had the highest performance. And small value, which theoretically you would expect to have the highest performance over long periods of time, has had lowest amount of performance. Since the market low, the numbers are different. Look at that, 586.5% for large growth stocks, but still not too shabby in these other areas for value. Mid-cap value, 520.8%. Blends, even small value, 413%. So as you increase as you look at particular periods, you get different periods of valuation or performance. Look at this. This is a really interesting piece of it. Howard, look where we are right now. Given this really strong performance by growth, look at the valuations right now. So the current PE for large U.S. growth stocks, 23 times earnings. Mid-cap growth, 25 times earnings. Small cap growth, look at that, 44 times earnings. That's in excess of the market peak during the tech bubble. And then look at the valuations of value stocks right now, 15 times earnings. So this is another thing that I do with your portfolios, is make sure that you have exposure not just to growth stocks, but to value stocks as well, so that we get some defensiveness on a valuation basis. This chart I show regularly, and this shows the inflection points, U.S. and international stocks. The U.S. is the S&P 500. It's in gray right here, and we can see that the U.S. has had a long climb over the last decade. International stocks have gone more sideways, right? But again, their valuation meaningfully lower as a result, 14 times earnings versus 18 times earnings. So again, just to emphasize why maintaining diversification during the current uncertain times is important. Let's move into the area of bonds and interest rates. You want to bet on interest rates? This is a really, really illuminating chart about what happens if you try to bet on interest rates. 30 Wall Street economists, professionals, this is what they do, is look at interest rates. They were asked to make predictions about the 10-year Treasury bond, 1992 to 2019, and here we're giving you just a handful of those years right here, 2014 through 2020. 57% of the time, there were incorrect predictions about the direction, just the direction. We're not even talking about how much, the magnitude, just the direction. They got the direction wrong 57% of the time. They couldn't even get up or down right. 43% of the time, they got it right. So, for example, in 2014, the economists' predictions were for 3.1% up. They were predicting interest rates to be up. In fact, they were down. That was the actual result. They were expecting that interest rates would be up to 3% in 2015. In fact, they were down to 2.2. 2016, the consensus was we're going to see them reach 2.7, and they were going to move up. they actually ended up down 1.6%, right? This is amazing. It got it right in 2017. Look at that, 2.2 and 2.2, finally. And pretty good, too, in 2018, 2.8% up and 2.9%. And then they went back to their old ways, these Wall Street economists. In 2019, right, this was the big shocker. This is why bonds had such a big year, is because those 30-plus Wall Street economists thought the market was going to be up to 3.5% for the 10-year Treasury bond. In fact, it was down to 1.8. Look at that. Huge difference. Half. Right now, they're predicting we're going to reach 1.95%, modestly up for 2020. Of course, we don't know where interest rates are going to go. The point of this slide is none of us do. And it's a folly for us to even try to guess what interest rates are going to do. This, of course, shows the long decline in interest rates. Look at that. Incredible. From 1958, we had a long rise in interest rates, right? We had the Vietnam War, rise in inflation, culminated in 1983. Remember, we had stagflation. I remember gas lines and really high interest rates. And then Paul Volcker, who recently died, who was the chairman of the Federal Reserve under Jimmy Carter and under Ronald Reagan, too, decided that they were going to really raise interest rates to put the kibosh on inflation. And look at this. This is the longest. So we've not only had a really long stock market bull market, we've had a really long bull market in bonds as well. So think about that. Not just a stock bull market. This may be the longest. I think it is the longest bull market in bonds in history. You know, any time along this point when you own bonds, you've done well with bonds, not just stocks. I hope I'm telling everybody things that they don't know, or giving you new ways to look at it. Look, here's the yield curve. Here's the yield curve, the change in interest rates, December of 2013, and here we are in December of 2019. Look at the change. Look how steep this was back then, right? Look at that. Why? Because remember, the Federal Reserve was holding down the short end of the interest rate curve. Remember, we couldn't get any interest paid on our bank deposits. Does everybody remember that? Just a few years ago, if you deposited money and had a money market fund, what did they pay you? Like 25 basis points or something like that, right? Or even zero. Remember, there was no interest to be earned on your deposits because the Federal Reserve was sitting on this end of the interest rate curve. And gradually, we see that the Federal Reserve has raised interest rates. Donald Trump wants to send them back to here, right? Even though we're at full employment and low inflation. That would make no sense. But he's, of course, jawboning the Federal Reserve and the chair of the Federal Reserve to do this again, right here. And here we are. So look, this curve has gone from this to this. This is where we are now. And what's really crazy about this curve? Well, what's crazy about this curve now is that you don't get paid a whole lot more to own long-term bonds way out here than you do to own a short-term bond right here. So why would you want to own a 30-year bond? Meaning, why would you want to lend money for 30 years at 2.39% when you can lend money for 1 year at 1.59%? Or even 10 years at 1.92%. So we have a very flat yield curve. And this is proving to be confusing and confounding to market watchers, because when the yield curve has inverted, we've had recessions. And the yield curve has danced around over the last year. You may remember back last summer, there was all kind of talk about inversion of the yield curve. And we have had inversions of the yield curve. We have a little bit of an inversion right here, right now, where the longer-term 2-year bond is yielding less than the 1-year bond. So I continue to watch the yield curve. We don't have any signs of a recession right now, but this is a little bit worrisome. When I say worrisome, it's worrisome because it's possible that it could presage a recession. It's all right if we get a recession. We'll get through the recession, but it's likely that our investments won't do very well during a recession. This chart I put in here just to show where yields are on certain bonds. And just as I just showed you on the prior chart, this is Treasury bond yields. 2-year, 1.58%, 30-year, 2.39%, not that much more. So I'm staying away from this kind of stuff. Longer term bonds, although they had a bang up year last year. 30-year bonds were up 16.43% last year. Why? Because when interest rates fall, longer term bonds go up in value more than shorter term bonds do. And you can see that. The 2-year bond returned 3% last year, 3.31%, 16.43% if you held 30-year bonds. And here's some other bonds as well for you to look at what the yields are. The highest yields here are in high yield corporate bonds, also known as junk bonds. So if you hold junk bonds, you're getting 5% coupon on your money. So I hold some junk bonds in your portfolio, but we don't only want to hold tons and tons of high yield bonds. Other bonds as well. Municipals have done well. A lot of people are looking at municipals now. 7.7% municipals returned last year, and that's tax-free. So if you put that on a tax equivalent basis, that's about an 11% pre-tax return. Still, the point here is that you're not earning a lot in bond world. So what do? Do we sell all of our bonds? It's not an easy question. Everybody's different. Some people want to hold bonds in their portfolio. Most people do, to have some stability in the event of a stock market fall. Let's go to the section on economics right now. Unemployment. Where are we here? Well, we're right here. Look at the long drop since the financial crisis in the unemployment rate. A lot of people working, employers in certain areas having difficulty. I think the restaurant business right now is having a lot of problems finding people, and it's just kind of a problem right now for employers to find enough people in certain industries to fill job positions that they have. And so 3.5% is the unemployment, the official unemployment rate right now, and we're seeing wage growth also. This is right here, the average wage growth dating back to 1969, 4% or so, and we're approaching that now. So we're seeing wage growth approaching. Still not there yet. 3.7% is where wage growth is nationally, but we're getting close to the historical 4% in wage growth. Manufacturers Purchasing Index. This shows the energy and dynamism in the and activity in the manufacturing sector, and we can see that we've had a long period. These are different countries, right? And we can see that we had a long period of green, lots of green, clear sailing, and lots of active manufacturing activity. 2016, 2017, 2018. We're cooling off. You can see this is the current time right now. We're cooling off. Germany's actually in a recession, a manufacturing recession, and I think we can attribute that to the trade tariffs that have taken place. Germany depends upon its automobile manufacturing, and of course, with the tariffs that are being assessed now, that is having a direct impact on Germany and on the euro area as well. And so we will have to see how these trade conflicts play out. Of course, the trade conflicts are taking place largely between the United States and the rest of the world. It's not as if, as I've said many times, it's not as if the world is at war with itself over trade. It's this country that is at war with the rest of the world over trade. And you know, if the whole world was at war over trade, it'd probably look like this, right? You know, red everywhere. Right now, we're getting particular breakouts here of slowdowns. But in general, we can see that the global economy is slowing. There's no question about that. Gesundheit. JC sneezed. So let's look at diversification and try to glean some conclusions. A lot of people are having S&P 500 envy right now. You know, why don't I just own the S&P 500? You know, it's done so well, and why do I need to diversify? Well, let's take a look. Here is the S&P 500 versus a diversified portfolio defined as 40% U.S. stocks, 15% international stocks, 5% small, 30% U.S. bonds, 10% high-yield bonds. From 2000 to 2002, the S&P 500 lost 40.1% over that period. This is not annualized. That's in total. 40.1% loss over that period. The diversified portfolio lost 18.6%. Right? So you lost less than half of the S&P 500 with the diversified portfolio, but you still lost money. Right? So what people were probably saying then, I lost money. Diversification doesn't work. 2003 to 2007, the S&P 500 did 82.9%, and the diversified portfolio did 73.8%. Everyone's grumbling. I should own the S&P 500. I didn't make as much as if I had just owned the S&P 500. So grumble, grumble. 2008, right? Big down year. S&P 500 lost 37%. The diversified portfolio lost less, 24%, but you still lost money. You're still grumbling, right? 3 grumbles in a row. 2009 to 2019, S&P 500, look at this, 351% up. The diversified portfolio up 191% over that period, and you are really unhappy. I didn't make as much. Well, when you put it all together, what's the picture? The diversified portfolio over this long period of time returned more than the S&P 500. Not a lot more, but it did return more, and the ride was a lot smoother. What's the conclusion? Diversification wins even when it feels like it's losing. So I hope everybody will pay attention to this particular slide. I really like this slide. Catherine's giving me the 10-minute warning here. We'll see if we can get through everything. I don't know if we will. Total number of, so access to U.S. private markets and international investments. Look at this. U.S. publicly listed companies. Look at the fall off in U.S. publicly listed companies. A lot more companies choosing not to go public. The yellow is U.S. as a percent of all publicly listed companies worldwide. So if you go back to 1980, the U.S. accounted for, right here, 30% of all publicly listed companies worldwide. Now where are we? Right here, 10%. So the U.S. accounts for 10% of all companies listed worldwide. So again, do you see why it's important for me to diversify you internationally? Why would we want to limit you to 10% of all the companies worldwide? That's crazy. And yet people do it all day long, every day in the United States with enormous, enormous amounts of home bias, what we call home bias, bias toward holding investments that are in your home country, in your home country. Here's diversifying in a single sector. Another slide I like all these slides. I wouldn't have put them in the presentation if I didn't like them. But look at this. Here's the healthcare industry. Healthcare stocks are up 10.4% over the last 5 years. Well, let's just say you said, well, I'm going to pick stocks. I know which are the good companies and which are the not good companies in the healthcare business, and I individually am going to go and pick those stocks. In the healthcare industry, 45% of the stocks were positive, and 55% lost money. All right? But what if you'd held healthcare funds? Why do I buy funds for you and not individual stocks? 96% of the funds made money. Only 4% of the funds lost money. And here are the numbers. Healthcare mutual funds, 58 of them made money, only 3 lost money in the healthcare sector. Exchange traded funds, 26 of them made money, only 1 lost money. And closed-end funds, 5 made, 0 lost. Versus the stocks themselves, 260 made money, 318 lost money. Diversification. Let it work for us. All right, a few more slides, and then we're going to turn it over to questions. Look. A few positives, quite a few negatives. We've got low inflation right now. That's always, or rather usually good. Inflation is now running not even quite 2%. Historically, it's run at 3%, dating back to the 1920s. So we're low by inflation standards, as most people know. We have growth in the United States. It's not the 4% that the president has demanded. We're at 2%. But it's growth. It's not negative growth, which would be a recession, but it is growth. And of course, we have very strong employment, and we have wage growth, as I noted before on the other slide. Negatives: valuations are tight here in the United States. The duration of the expansion is the longest expansion and stock market, bull market. Everybody knows about this, the trade conflicts, and they have had definite impacts on the global economy. I don't even need to mention this, especially not today. Politics. And none of us knows what sort of risks the politics are going to present here in 2020. But I'm not taking any chances by investing all of my wealth in the United States. And I'm not going to take that chance with your wealth either. Earnings and margins under a bit of pressure now. We've seen earnings really rise steadily over this bull market, including and especially right after the 2017 so-called Tax Reform Act, which slashed corporate taxes. Remember that? Massive slashing of corporate taxes from, like, what was it, 30-something percent, 33, 35%, down to 20%. 25%, I forget which. Anyway, it was a massive slashing of taxes, and so that gave a big boost to corporate earnings in 2018. But the sugar high of that is and has worn off, and so earnings and margins are retreating back to a more normalized state. And in fact, we're only going to see an increase in earnings of about 2%, I think, and of course deficit. So, as always, as I started the presentation talking about, always there are negatives, always there are concerns out there, and yet we had a rise over the last 10 years. This is Vanguard's 10-year projections as we look forward. So just sort of take that in. There's a lot of numbers on the page. Maybe I'll just say, look for the highest number. Where do you see the highest number? Of all these different categories, where do you see the highest numbers? Everybody sort of survey the page. Well, you can really see quickly on the right. We can rule all that out in the world of bonds. All that's in the 1 to 2% category, high yields 3 to 4. So yeah, that looks pretty good, 6 to 8%. But here's the highest prediction by Vanguard. That's not a very small company, by the way. Vanguard, the largest asset manager, I think, in the world. Maybe BlackRock is. Both of those good partners to the New Capital Management. Global equities. International stocks are where Vanguard is expecting the highest returns to be on average each year over the next 10 years. And the other area, U.S. value stocks. What about U.S. growth stocks? What about get me some more Facebook and get me some more Tesla and all this? This is their expectation for that as a group. I'm not saying that particular companies aren't going to hit the lights out. But this is Vanguard's expectation for what U.S. growth stocks are going to do over the next decade. Why? Because they're valued so highly right now. U.S. equities, 3.5% to 5.5%. So if your portfolio is all in U.S. equities, you will do, on the high side, according to Vanguard's predictions, 5.5%. So if you come to me telling me that you want to make 10% in your portfolio, I can't get you there according to Vanguard's predictions, and I think that their predictions are entirely reasonable, by the way, even if I put you 100% in the U.S. stock market. The closest I can get is if I put you 100% outside the United States at 8.5%, and that's 100% stocks, non-U.S. Now, what if you have a blended portfolio between fixed income and equities? Now you're going to get a mix between, maybe 5%, and in bonds, maybe 2%. And if that's a 50-50 portfolio, what do you end up with? Right in between 5% and 2%. What is that? 3.5%. So this is the conundrum that we face in this world of investment right now. And that's what's going to push people into this area and into this area. Just a little bit more, and we'll go to questions. What am I doing about portfolio positioning? Well, here's some things. I am actually beginning the process of reducing credit bonds, meaning bonds issued by businesses, because I'm concerned that if stocks have difficulty, that credit bonds are also going to have difficulty because they're issued by the same companies. And I'm also looking at increasing inflation-protected bonds. Inflation-protected bonds in the United States, but I'm also looking at inflation-protected bonds outside the United States. Inflation-protected bonds came out in the late 90s, and they were intended to provide a U.S. Treasury that would compensate investors for an unexpected rise in inflation. Right? The country had gone through this really traumatic period of high inflation, which I discussed before. Interestingly, TIPS have really never been needed since then because we haven't had a period of high inflation. But we could get a period of high inflation, and we have things that are calling for high inflation. Fiscal policy, right? The spending by the federal government is inflationary. And monetary policy is also currently inflationary because interest rates are low. We had the other day the President of the United States calling for a weaker dollar. Since when does the President of the United States call for a weak dollar? Well, I guess he does now, which is inflationary. So I'm a little concerned about this, unexpected inflation. And the time to buy insurance is when it's cheap. And inflation insurance right now is pretty cheap. So I'm looking at making some moves in that area. Continued market weight international exposure. If I haven't convinced you of that in this talk, then I'm never going to convince you. Maybe more defensive equities, taking a look at some options there, maybe some consistent dividend growers. And I'm also looking at some private equity, but it's expensive and the fees are really high. I'll let you know if I see anything there. Is that the last slide? It might be. Let me see. Oh, what you can do. This is the last slide. So what are some things you can do in the current environment? Well, mortgage rates are at 3-year lows. So a lot of people have already refinanced. But if you haven't, and it seems like you should consider it, then this is a really, really important time to do it. I don't know that you're going to get another bite at the refinancing apple. You might. I've thought that for a long time, that rates were going to go up like a lot of people, but they haven't, and they're now low. If you want to talk about that with me, feel free to contact me, and we can look at your current mortgage and what your options are. It is still an excellent time for contributions to your charitable fund. Why? Because stocks were up so strong last year. There are gains in stocks, and if you want to rebalance your portfolio, a good way to do that, and you're charitable, if you want to do both of those things, be charitable and rebalance your portfolio, more than likely you're going to have gains in your portfolio that we can take those appreciated securities and put them in your charitable fund. And we can do that for the next 10 years, not put the money in over the next 10 years, but we can put enough money in to carry you over for the next 10 years of charitable contributions. And then you're done. You funded your charity using appreciated securities, and we beat 2 taxes when we do it. We avoid 2 taxes, the capital gains tax, and you get your usual income tax deduction. When you give cash, you only get the income tax deduction. But when we donate your appreciated securities to your charitable fund, you also beat that tax, the capital gains tax. Review meetings. Please make sure to keep your appointments with us to come and see us so we can update your individual situation and see if there's something that we want to change. And then, of course, here in 2020, please get active, vote, and encourage others to vote. Okay, that does it. It looks like I'm about 3 minutes over on the presentation. Sorry I went a couple minutes long. If you have any questions, go ahead and lob them in. Okay, here's a question. I have proved that pessimism year over year is not warranted. However, what does long-term recovery trend tell us about next year? That's a good question. And the answer is nothing. We don't know anything about, and I assume next year in the context of this question means this year, 2020. It tells us nothing. In any given year, we don't know what we're going to get in securities markets. That's exactly the point. We do not know. Nobody knows. And I mean nobody. Anybody who tells you they know, they're lying. Or they're delusional, because nobody knows. Our experience in our securities markets tells us that a long-term view is required. 5 years, 10 years, even 20 years. So it doesn't tell us anything. I have no idea what this year is going to bring. Markets could be up 50%. They could be down 30%. They could be down, 2%. They could be up 3%. In any given year, we simply don't know. Another question, what effect will climate change have on investment strategies? And then another question's come in from another of our client guests, similarly, environmental portfolios. There's a lot going on in this area. We posted the other day one of our investment partners is BlackRock. Lawrence Fink is the chairman, and because they control so much money, there's a lot of pressure for them to assert more governance. Why? Because they vote our shares, right? When we hold mutual funds, they own the individual stocks. And one of the things that New Capital is going to be releasing, and I've already told our partners, and I think we're the only independent firm that I know of that's doing this, I'm working on this, where we're going to tell our clients that they must represent to us that they are taking active steps and active measures to vote for corporate directors and boards that are supportive of environmental, social, and governance principles, or we're not going to be able to do business with them. So there's a lot of pressure, and all this is coming up from below, from you to me and from me to them, and it is one of the most active areas. And so we have environmental portfolios, we have environmental funds already. A number of clients like to avail themselves of that option. Not everybody does, but many do. The good news is that more and more is coming out every single day. New approaches, new funds, lower costs, and that's helpful. But the active steps that the fund companies are taking to actually vote and take active roles on the corporate boards themselves is really going to have an impact. Really going to have an impact. And the news in this area continues to be very promising. There will be another, I think it's like another record amount of coal-fired power plants will close this year. After all that the Trump administration has done to keep those open, they are still closing apace. The politicians cannot stop that from happening. The market is dictating that as the price of renewable and alternative energy happens. So, as I've said, the strange thing about our country right now is that our people and our businesses are out in front of our government. It's not our government that's leading. It's our businesses that are self-regulating at this point. The government has given up, for all intents and purposes, the job of regulation. And our businesses are doing their own self-regulation. I understand that not all the businesses are, but many of them are, and many of our biggest businesses. So that's one point about it. Another point about what effect climate change will have on investment strategies, it's hard to say. Obviously, the fossil fuel businesses are going to be impacted, I think increasingly so. But I want everyone to realize that the fossil fuel businesses used to be 20%, say, of the S&P 500. I'm just picking a number, but it's up there. And they're down to 5% now. So the market has taken care of the discounting of the value of those businesses automatically. You know, it's not even like we've had to sell it all out of the portfolios. They have been whittled down in their importance automatically by the markets in portfolios. So the oil business used to be 20% of the economy. Now it's 5%. As technology and healthcare and new types of retail and the finance business, all these have grown much larger, absolutely and relatively, to the fossil fuel businesses. I hope that answers the questions, but for sure, it's an issue that's going to continue to be on the front burner in the investment world. Any other questions? All right, everybody, thank you very much. I hope you have a fantastic weekend. I'm going to go to my place in the country and get some R&R, and look forward to hearing from you all and talking with you soon. Take care.